We spend hours analyzing which stock to buy, but almost zero time planning when to sell. This is probably why most investors lose money. They hold on to their winners until they turn into losers, or they panic sell great companies just because the price dipped a little. Today, I'm sharing the 3 strict sell signals you need to write down and stick to. If a stock you own hits one of these signals, you exit. No emotions, no second guessing. Signal number 1, the original thesis is broken. This is the most important signal, and it has nothing to do with the stock price. It's all about the business. When you first bought the stock, you had a specific reason, your investment thesis. Maybe it was something like, I'm buying company X because they are growing their cloud revenue by 20% every year. The sell signal triggers the moment that reason is no longer true. For example, if that cloud growth suddenly drops to just 2%, or a major competitor launches a superior product that completely shatters company X's competitive advantage. The key takeaway here is simple. If the story changes, your money should change locations. Do not hold on to a growth stock that has stopped growing just because you think it looks cheap now. Signal number 2 is extreme overvaluation. This is what you watch for when a good stock becomes a little too popular and the hype gets out of control. Sometimes the market just gets irrational. A fantastic company can become a terrible investment if the price you pay is disconnected from reality. The signal here is when the valuation metrics go crazy. A simple metric to watch is the P/E ratio compared to the company's own historical average. As a rule of thumb, if a stock normally trades at around 20 times its earnings, and suddenly it's trading at 60 times earnings without a massive, fundamental acceleration in its growth, that's a sign the market is euphoric. You don't have to sell your entire position. Consider trimming. Sell maybe 20 or 30% of your shares to lock in some of that profit, while letting the rest ride just in case it keeps going up. The third and final signal is finding better opportunities elsewhere. You have to think like a portfolio manager here. Your cash is a limited resource. Every dollar you have tied up in stock A is a dollar you cannot put into the potentially explosive stock B. The signal triggers when you find a new company that offers a significantly better risk-to-reward ratio than something you currently own. Imagine this scenario. You own a safe, stable stock that pays a 2% dividend. Then, the market has a correction, and a high-growth tech giant you've always wanted to own is suddenly on sale for 50% off. Your move. You sell stock A, not because it's a bad company, but to free up cash to buy the superior opportunity in stock B. This is a pro-level move called high-grading your portfolio. Now, before we wrap up, there's one thing that is absolutely not a sell signal, and that's a simple price drop. If a stock's price falls but the underlying business is still healthy, the thesis is intact, and the valuation is now even more attractive, that is not a sell signal. In fact, that's often a buy signal. Never, ever confuse the stock price with the business's actual performance. Look, I get it. Selling is hard. It's emotionally painful. We've all been there, staring at a screen, praying a losing stock will turn around, or kicking ourselves for selling a big win away too early. It's just part of the game. So now I want to hear from you. What's that one stock you held onto for way too long? What was the expensive lesson that it taught you? Drop your story in the comments below. I'll be hanging out down there to read about your battle scars, so we can all learn and get a little bit smarter together. Thanks for watching, keep your head in the game, and I'll see you in the next one.